Hey, Steve Saretsky here. Welcome back to the show. Lots to touch on this week. I got Canada's CPI inflation, how I think that's going to impact the Bank of Canada and their rate announcement next week. I've got some issues that I'm seeing with the Canadian consumer. I've got some big data that's coming out from the GTA and our contacts over there. And I really want to frame that all up for how I see markets moving forward, of course, particularly here in real estate. You guys know I record this show. It goes out every Saturday. I record this on a Friday. We're in the depths of the summer, so we're going to have a little bit of fun of it. I'm enjoying a nice glass of Burrowing Owl Pinot Noir, one of my favorite bottles of wine locally here in BC. If you have any comments or suggestions for nice Pinot Noirs you enjoy, love to hear them in the comment section below. But let's get into the CPI data. So you've got CPI inflation for the month of June was expected to come in at 2.8%. It came in below expectations, 2.7%. So we're kind of range bound, right? The Bank of Canada has a target range on inflation between basically 2 and 3%. Okay, so they do have that range. So they don't have a mandate that says you got to hit 2%. So 2 and 3. So they're within that band right now. And that's what we saw the Bank of Canada cut last month. And so inflation's been kind of bouncing around into the high 2s over the last several months. Now, one of the things I want to point out is that if you look through the inflation metrics, you see, okay, well, what's happening? Remember, shelter inflation accounts for roughly about one-third. One-third of the total basket of CPI inflation is shelter. And so I live in a shelter. I not only do I live in a home, but I sell real estate on a day-to-day basis. It's the market that I focus on. It's probably why you're here watching this YouTube show. And so when I look at Canadian housing markets, when I see what's happening here in Vancouver, the market that I work in, or in the GTA, a market that I watch very, very closely and I have a lot of close contacts in, is that it's pretty well documented that Canada is going through a housing recession, right? So you've got resale home prices are falling. You've got significant weakness in the new home construction market. And you got rents that, yes, while we've had 1.2 million new immigrants coming into this country over the past 12 months, we've actually seen rents peaking out. Basically, they've kind of hit that ceiling of what people can sort of absorb. The labor market, of course, is starting to weaken. The labor market is what drives higher growth in the rents, right? I mean, if you're not getting a raise at your job, or if you're getting laid off, rental prices are not going to increase at that level. And so everything that I see in the rental and in the resale market is pointing towards disinflation or deflation, outright deflation, right? Like resale prices are dropping almost unanimously across Canada, other than maybe Alberta. And you've got the rental market, which is clearly peaked. We're seeing declining rents in the GTA. We're seeing rents here in Vancouver that peaked about 12 months ago, and they've been flat. There's been zero growth. So if you're asking about rent inflation, it should really be at zero for large parts of Canada. Yet, if you look at what's happening in the rental market in the CPI basket, rent growth is actually still accelerating as part of the CPI basket. So rent growth is running actually at 8.8% on a year-over-year basis. And again, I always question, is that really what's happening? And so I think that while the Bank of Canada was really late to raise rates, right? I mean, they started raising rates in March of 2022. That was 1 month, guys. That was 1 month after the peak of the residential real estate market, which peaked pretty much in February of 2022 across the vast majority of Canadian housing markets. So Bank of Canada started raising rates late because I think they're using really lagging data. And I think we can see this predominantly in the shelter component, right? Anyone that's watching this channel knows that, I sit here every Saturday and document what's happening in the housing market. And people that are paying attention know that we're seeing, again, declining prices. And in large parts of these markets across Canada, we're seeing declining rents. So why is rent component inflation running at 8.8% year over year? Because it's just playing catch up. It's lagging data. Data is by nature things that have already happened. In order for you to report on them, they have to have already happened. And so that's the data that the Bank of Canada is relying on to set monetary policy for the entire country. And so that's where I always kind of go, this is something to really, really pontificate and think about. And so as of right now, markets are pricing in just over 90% odds of a rate cut from the BOC next week. So the rate cut is for sure, it's coming. Okay, so we've got another rate cut coming for the Bank of Canada. It's going to be 25 basis points. Now, again, that's really not going to do a whole lot to your variable rate mortgage. It's going to be still stuck in the mid to high fives. Your fixed rate mortgages have already priced in that move. Keep in mind, your bond market has already priced in the expectations that the Bank of Canada is going to cut next week. And so if you look at the 5-year bond yield and where mortgage rates are happening today, 3-year fixed rates, most aggressive lender we're seeing today is TD Bank. That's a 3-year fixed rate at about, call it 4.79%. So you're not really going to see any change there. So the Bank of Canada cuts rates next week. Your fixed rates are not going to change. What you're going to see is a small, modest change in variable rate mortgages. And so why I bring this all up is I don't think it really helps the housing market. The reality is there's still a lot of people that are struggling. The rate hikes are finally passing through into the Canadian consumer. People are now, again, finally everyone's starting to renew their mortgages or has recently renewed. And they're now starting to see those higher payments, right? And so when you start to see those higher payments, you're forced to cut back. The last thing people are going to give up is on their house, right? I mean, you're going to keep your family in your home. You're going to keep your, you're going to keep your mortgage up to date. And so what you do is you start pulling back on spending. But most people don't do that until the last final minutes, right? I mean, I had family growing up that was in the consumer debt proposal market. So people that file bankruptcy or people that go for consumer proposals, that was what part of my family actually did for a living. And so I'm very well ingrained growing up as a kid, knowing the human element and the psychology behind people borrowing money and people not realizing when they're in financial difficulty is people will kind of draw it out as long as possible. It takes actually a long time for this stuff to filter through. And we're only now starting to see it filter through. Like, look at the number that came out. So again, we had CPI data that came in softer than expected. We had retail sales come in softer than expected. So Canada's retail sales slumped on higher rates as that are weighing on shoppers' receipts. Fell 0.3% in June after a 0.8% drop in May. But most importantly, sales have only grown in 1 month of 2024, okay? Now, keep in mind, the data that is being quoted here from Stats Canada via Bloomberg is not accounting for inflation, which is running at 3%, right? So your retail prices are growing by 3%. And it's not accounting for population growth, which is also running at basically 3%. So retail sales are getting absolutely creamed, right? People are pulling back. And these are the anecdotal conversations that you have with people. I have them on a weekly basis with people that are running very successful furniture companies across Canada, very successful renovation businesses, very successful, you name it. It's all pulling back in Canada, and you can see this. So what are we saying? We've got declining real estate prices, declining rents, declining consumer spending in the GTA, right? In GTA, I mean, that's the largest housing market in Canada. It's really the epicenter of financial markets here in this country. It's our largest population. New home sales, right? New home sales for the first 6 months of this year, the GTA are running at their lowest levels since 1997. Okay, so think about how much real estate drives the Canadian economy. Think about how many people are employed in the construction sector. It's roughly 9% of the Canadian labor force is employed in the construction sector. And you've got new home sales, right? New home sales, which lead housing starts, are running at the lowest levels since 1997. Think how much your population has grown over that time span. And to say that new home sales are the lowest levels since 1997. And this is not just a GTA story. This is what we're seeing happen in Vancouver, in Ottawa, in Montreal. Home housing starts are pulling back dramatically. The only place they're not pulling back in is Alberta, because again, you've got this oil boom, this affordability, and that is counter-cyclical to interest rates. So it's a totally different housing market. And so I look at all of this, and this is my conclusion, just a normal person, just a guy that follows housing, that has a passion for financial markets, that likes to drink Pinot Noirs on a Friday night. This is where I think the Bank of Canada is behind the curve. And again, you guys can come out here and comment in the comment section and say, well, housing needs to correct, But for the Bank of Canada's purpose, for their mandate, for economic stability, for employment, for stable inflation, I believe the Bank of Canada is behind the curve. I think that while they're going to cut 25 basis points next week, it's not going to be enough to stabilize the economy. It's not going to be enough to stabilize the housing market. I think that they're behind the curve. And I think that they're behind the curve the same way that I was sitting here on YouTube talking about them being behind the curve in 2021 when they should have been raising rates prior to national house prices rising at a 26% year-over-year basis, the fastest pace of home price appreciation in Canadian history, at least the Canadian history that's been documented over the last 20 years. I was telling you guys they should have been raising rates. I think today that they're far behind the curve. Obviously, they're at the mercy of other central banks, et cetera, et cetera. But when I see guys such as my friend that I subscribe to, highly plug, recommend, Ben Rabideau, who runs a research service that he does to, hedge funds across North America, to big bank institutions here in Canada. When I see a guy that comes out and tweets, this is a terrible Canadian retail sales print, the worst he's seen since the early days of COVID. This is a guy that is incredibly plugged into markets, a guy that I have a lot of respect for, and a guy that I share a mutual view on where we are today. Again, to see new home sales where they are at in the GTA, and we're seeing this in Vancouver too. We're going to see 10-year lows in new home sales in Vancouver today. The amount of leverage and the amount of emphasis of Canadian economic growth that's been put on real estate and construction and population growth, and the construction to support that population growth, that's the whole economic model here in Canada. You might not like it, you might disagree with it, you might think we need to change it, but that's the whole model in this country. And so when you start seeing new housing starts collapsing, that's going to be a massive drag on economic growth. Not necessarily today, but like 6, 12, 18, 24 months from now, when new housing under construction completes and there's no jobs that are left over because housing starts have been collapsing, a year or 2 years in advance, that's going to be a real air pocket for the Canadian economy. And so that's kind of my view today, is the Bank of Canada is going to cut rates next week. It's not going to be enough because in reality, the bond markets have already figured that out in advance. They're not going to move. It's not going to provide the release valve for these Canadian consumers. And Canadian consumers ultimately are highly indebted. They're very stretched. They're very levered. And it's going to take a lot of cuts to provide the financial relief to these Canadian consumers and to ultimately kickstart a new housing bull market, which I don't think we're anywhere close to in the very near term. So that's my views. Again, hopefully everyone's enjoying a nice glass of Pinot on a Friday night. If you're watching this video on a Saturday, enjoy a glass of Pinot on your Saturday night. As always, guys, appreciate the support. See you next week.